The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
What I'm going to walk you through is basically in response to one of the questions that came in after our last webinar, and that is, how do we deal with this? How do we make decisions with the portfolios that we run for our clients? And I'm opted to do that by using what we do for our corporate 401k clients. So we have 401k corporate accounts where we determine and we review annually whether or not the menu, this list of assets, is appropriate based on fiduciary standards. And so in this case, including a cash benchmark and treasury bills, short-term treasuries, we have 35 assets for employees to choose from. As we have explained in previous webinars, we want to own things that are leading. So these are ranked by the last monthly return, and this is the December data, end of year, and the greenish area here are the top 10, because one of our portfolios we run is called relative strength. It's the 10 strongest returns over the preceding month. These others that are in kind of the orangish color are anything less than the top 10, and we identify where cash is, because part of our concern is if it's earning less than cash, we just as soon hold the cash as a defensive protection of capital. So this next slide shows you the change over the last 4 monthly ends. So it's December, January, February, and March monthly ends. And if you just read the top 10, you can see, well, let's go back to the end of December. Small cap 600 was number 1. It was also the S&P 600, but instead of being iShares, well, it still was iShares. It was just the same fund. I changed the way I abbreviated the name. The next month was large cap, and this last month was gold. These changed in time. Our cash benchmark, our bogey that we want to stay above, in December was number 34, but in January had moved up to number 21, which meant for us, everything below this list, we did not want to own in portfolios. So that included bonds, retirement account, there's international in here, mid cap and small cap, emerging markets, and real estate. We're all below cash. The next month, the market got a little less defensive, a little more risk on. Gold had slipped up part way. Wasn't up in the top 10 yet, but it was working its way up. Now we actually do this on the 15th and the end of the month. So I'm showing you just month end stuff, but we're looking at this twice a month to see where these changes are. And then the end of this month, cash was at the bottom. So we're basically, this is a risk on environment. You should be in the market. That's what this tells us. And there's been a shift with gold at the top. This permanent portfolio is gold and silver. So that's a commodities exposure. And we have international, and our target date funds have slipped down off the list. This tracks gold back here in December. Excuse me. Yeah, there's gold. This is kind of off the center of the line. That's gold here at number 31. It moved to 28, moved to 27. Those aren't big moves, but this last month, it's moved all the way to number 1. Had an intermediate step in the middle of the month. Now, how does that affect portfolios? So here's the top 10 in the 401k accounts. We run 5 models. We run a top 10, we call relative strength, and we run an aggressive portfolio called top 5. What's the difference? Well, each of these positions have 10% exposure, and each of these, which are the same as the top 5 up here, that's all they are. We just concentrate to a 20% position in each of these. So as the market shifted and leadership changed from small cap stocks to gold, we gradually worked our way in. Now, in a 401k plan, you can't walk away from modern portfolio theory. And for those of you who are clients, you know that we have not used modern portfolio theory for a long time. When after the '08 market, we figured out that it's basically built on a myth, on bad logic. It has good math for a specific purpose, but not for portfolio management. So we also run 3 other portfolios that are a modified modern portfolio theory. And for those, we look at data, which we have often shown you, which is our macro asset class ranking. So in here, we have major asset classes: gold, commodities, the Russell 2000, that's small cap; international, the S&P 500, and we have technology, there's emerging markets, and bonds, the 20-year treasury, and a broad bond market from Barclays. So starting in December, we basically look and say, where's the strength in the market? It happened to be in small cap. That's the #1 asset class. And then bonds were still doing okay. The Dow is US stocks, the technology is US stocks, the S&P is US stocks, the SPY is S&P, and then we have international. So asset class 1 is US stocks, asset class 2 is bonds, asset class 3 is international stocks. And so in our models, we look at this classification. The X's basically mean it's a tracking ticker that we're using for reference. We don't buy it in the 401k. And down here, it means it's below cash, which means we're not going to buy it in this review period. So when we look at these 3 models, we have a range. What is different between this and modern portfolio theory is that modern portfolio theory, as it is applied across the industry, is there's always exposure to US stocks. There's always exposure to international stocks. There's not always exposure to commodities. There's always exposure to fixed income. I need to update this. This is actually 0 because we will go to 0 on these. So we have different upper limits, and then we have modified hours so that they are 0 on the lower end on all of these. So here's the major changes. The conservative can never have more than 40% US equities. Moderate is 75 max, and the aggressive is a maximum of 80. On bonds, they can have a maximum of 80. Here it's a maximum of 60, and here it's a maximum of 40, but we can always go to 0. So what I did is I just took the moderate one and walked it through the same 4-month end periods that we have had on the prior slides. So at the beginning of this period, December 31, the moderate portfolio had exposure to the maximum level of US stocks. And then bonds were still acceptable, so we filled that up to the maximum, and then we'd spend all the money. That was 100% exposure of the capital. In January, the cash benchmark had moved up, so we ended up with less exposure to equities, and a lot of things in the model were below cash, so we held 3-month treasuries to collect a higher rate of interest than just sitting in the custodian's brokerage account. February, things improved. We're back into exposure, picking up some exposure to both gold and silver, and some international. And here we are in March, gold and silver, we are at maximum exposure. It's 10% that's allowed in the model. And then we have maximum US stocks. and then we have some international stocks. When we did this last month, this is our conditions that we had with our models that we run for individual clients. Are condition adaptive, just like I showed you with the 401k plan. Conditions change, and so the decision model, the decision-making process, forces a change. Instead of having a fixed opinion about the way things should be, we deal with reality, the way things are. And that requires at times some difficult decisions overriding your opinion and your emotional response. So here as of Friday are the exposures that we have in the 3 models. So in the select model, we do not have exposure in the menu for sector exposure. It all comes through broader diversified index exposure to the market. Global and dynamic, you can see here we have oil and gas exposure, home builders exposure. There's some materials, energy, there's natural gas that's really related to energy. And the same thing over here, we have infrastructure, gold, home builders, metals, energy, and there's still some large cap in here. I hope as I've walked through how the market returns change, leadership, sectors rotate, that you can see and understand we're not in the prediction business, we are in the interpretation business. We do not have a forecast that we use to determine what goes into the portfolios. Nobody has an accurate forecast. Sometimes people have lucky forecasts because nobody knows the future. Markets are dynamic, they're constantly changing. Preserving your account or having an account that makes money and meets your financial goals isn't for slackers. Somebody has to actually work at this. Somebody needs to pay attention and worry about it, and more importantly, make a decision and act when conditions change. What we do is not rocket science. I just showed you what we do. I mean, you can replicate that data on your own, and I told you how we go about adjusting portfolios. This is not rocket science. You spend a little bit of money on some data, some time, and discipline to build your rules, monitor, and take action. You can do this yourself. And if you're not inclined to do that, that's why our business exists. We're here to do that for you. You need help? Here's how to get it. Send us an email, help@iriradio.com.